Last chapter we looked at was 29, so we need to put a heading for 30. And that's the last chapter called forecasting and managing cash flows. Okay, so also a little bit of accounting, but slightly different accounting. Okay, so this is accounting fundamentals. Lots of revision here actually, because you've done accounting before. So you'll see it'll go quite quickly. A lot of the basics you'll probably recall. Right, perfect. You've got a nice big heading. Just to recap, when you see the word accounting, what's the first thing that comes to mind?
Money.
Well, yes, but accounting is not so much the money, it's the record keeping. That's the key. So accounting is a way to take data. Data is converted into information. That's what you're looking at. So yes, we're going to be dealing with money in terms of buying things, selling things, etc., etc. And all of that needs to be summarized. And this is how we summarize the information. So businesses are going to need accounting, and that's why it's part of your business studies, because it's the information that helps people make good decisions. That's the key. So we've looked at that before. I'm just going to put a note here, making decisions. And that's why we need accounting. So the learning outcomes here, maybe you can just read those 6.
So it's understanding why keeping business accounts is so important, analyzing the main uses and uses of business accounting records, identifying and understanding the main components of an income statement, identifying and understanding the main components of a statement of financial position, analyze business accounts by using ratio analysis, liquidity and profit margin ratios, evaluate the limitations of ratio analysis of the published accounts.
Okay, so having read those 6 learning outcomes, do you agree, are they going to cover all the accounting? No, they're focusing on what?
The
main financial statements.
Yeah.
Okay, the actual information that you get. So they're not really going to look at transactions, journals, ledger, etc.
Yeah.
They're just going to be looking at, well, what do we actually have at the end, and how does that help us with decision making? So you can see they spoke about the income statement and they spoke about the financial position. We're obviously going to be looking at ways of making decisions, and that will require some analysis. Okay, so doing calculations. How much did we spend? How much did we get in terms of sales? And that will help us with profits. Okay, income minus expenses. Right, so introduction wise, you can probably put a definition here if they've given you one. Okay, they haven't. Okay, so let's create a definition for accounting. Accounting is a language, business language for communicating transactions. So when dealing with transactions, you're going to have sales, you're going to have purchases. If I buy an asset, that's very different to buying or paying for an expense. Right, those are some of the things that we'll look at here, but from a decision-making point of view. So when focusing on accounting, accounting is just this, just a language. It's a way for everybody to communicate things using the same set of rules. Okay, it's like now we're talking in English. If we were speaking a different language, it would just be one way of what? Expressing information. Right, so this textbook, is written in English. It's just a language for expressing information. Right, so now we're on chapter 30. We've covered lots of different chapters. We've covered lots of different information. Okay, lots of different points. Okay, so when looking at accounting, it's the same thing, but it's focusing on what? Money or transactions. That's the key. Okay, you're looking at this. That's what you're focusing on. Makes sense? Perfect. The textbook here, in terms of introduction, talks about monetary records of transactions. They talk about keeping simple accounts. They also mention here, all businesses have to keep detailed records of their purchases, sales, and other transactions. That we can write down. Businesses need to keep track of all transactions. Buying, selling, you name it. That's their responsibility. So as a business, we need to make sure that we've got the right systems in place. Okay, so do we have an accounting package? Do we have a system? Do we have journals and ledgers and trial balances and all of that? Okay, the textbook talks about management and financial accounting. So this is something that we've covered before. So you can probably give me the differences. I'm going to use a table here. Okay, so financial accounting. And then the other one, management accounting. Okay, just to summarize the content that's here, I'm going to put in a table. Hey, do you remember what the difference is? Any idea? Management and financial?
No.
Okay, so financial accounting is looking at reporting. Management, the key word is manage. So which would be more detailed or summarized?
The manage.
Management would be what? More detailed or summarized?
More detailed.
More detailed, exactly. So detailed records, financial accounting, summarized information. Right, so here's the example. Financial accounting. We're going to give this to who? The users. Right, so let's say the investors have invested in the company. Do the investors want to know every single product in terms of sales? No, they just want to know of all the products, how much did you sell? That's all they want to know. But for the management, are they going to want to know which products are selling better than others? Of course they do, because that's going to affect their decision making. Right, so in the textbook they said management and financial accounting, there are several different branches. Two of the most important types of accountants are management and financial accountants. Management accountants prepare detailed and frequent information for internal use. Let's add that to our table. Creating frequent and detailed information. Right, so let me ask you about a company. How often does a company present its financial statements? No. The statements?
Oh, the statements, yeah.
Yearly, exactly. Good. And for management accounts, would you only want information once a year? No, you wouldn't. That'll be very, very, very problematic. Right, so financial accounting, financial statements. Okay, so with the financial statements, because once a year, even for them, is too much or too little. So you do get something called interim and you get final. Okay, so it actually comes up twice, but the interim is just like a kind of like a snapshot. This is how we're doing, but it's not the final version of the statements. Okay, so the final version is actually the most important. That's what we're actually looking at. In terms of management accounting, how often do you think people are going to be providing reports?
Monthly. Monthly,
sometimes even daily. You might have to present a report daily for the managers to look at. Okay, because the managers might want to know, well, today, how much have we sold? Today, how much have we produced? Today, what's the marketing like? What's the advertising, etc. Okay, or have we managed our stock, etc. Okay, so there's a lot to consider. The nice thing about the textbook is they give you some of the details here. Just to add maybe, they said foundations of accounting are important. We need to know what the basic principles are. So even in the textbook they're talking about basic principles. Okay, later they talk about double entry and so on. Okay, we'll come to that just now. Right now we're still dealing with financial and management. Okay, what is the other difference between financial and management? Well, in terms of not only detail but scope. Scope, less. I'm going to rather write more higher level information. Okay, when I say higher level information, it's looking at, so for example, would the director have information on all the different units? Yes. If I have a financial account, okay, so i.e. if I've got the financials, will there be as much information on every single unit? No, there wouldn't. So the scope would be a little bit more limited. So financial accounting, scope, high level information, brackets, limited. Okay, so there's only so much information you can get. And then with management accounting, right, wide scope, many departments, not limited. Okay, not limited meaning if you wanted to know something about the business, you could go investigate, you could do the research, you could survey, you could find out what the data says, and then you're going to have a set of management accounts. Okay, I like this little table here that they're giving you in terms of problems and who does it affect. So let me run through the list and see if you'd be able to identify the user. Remember, users are the ones that make use of the information. We just said accounting is a language for expressing transactions. So we're going to use that and we're going to create reports. You get management accounting reports, you get financial accounting reports. Yeah, the last note there is just the scope. So with financial it's more high level, and with management it's more wider. Okay, so let's ask the first question. How much did we buy from our suppliers and have they been paid? Who's going to be affected? Which users would be affected? For that first question, how much did we buy from our suppliers and have we been paid yet? And have they been paid yet?
Yeah.
Who's that going to affect?
The supplier.
The supplier, good. So the supplier would be internal or external?
External.
External. Okay, so another note here. Financial accounting, external. Management accounting, internal. Right, so the managers are going to know when they're going to pay the actual supplier. The supplier won't know. What will the supplier know? Well, they'll know how much debt the business has, do you agree? They can look at the statement and see, oh, they've got a certain amount of liabilities and a certain amount of assets. If the assets are more than the liabilities, is that good? Yes. So as a supplier, would you supply a business that has assets more than liabilities?
Yeah.
Yes, you would. See the decision making. So when looking at the decision making, you're going to have two different views. You're going to have the managers and you're going to have someone external. So you'll see in this table here, for all these problems, the managers are always involved. Why? They need to make a decision. But it's the other part that we need to look at, okay, as well. Right, so next one. How much profit did the business make last year? Who's that going to affect? Besides the managers.
The business.
What of the business? The investors. Okay, the shareholders. Are shareholders internal or external?
External.
External, good. Okay, is the business able to repay the loan? Who's involved? Obviously the business, which is managers, and
The bank.
perfect. The bank would be external. So again, the bank would need information. They would need summarized information, and they could maybe request for more detailed, depending on what type of loan they're applying for. They've given you another table here, but this is just looking at other considerations in terms of operations. Okay, so as a financial accountant, what are you going to do? You're going to collect data and you're going to provide information. Okay, you're going to look at the transactions. Management accounting is going to be providing preparation of information for managers on the financial aspects of a business and its departments and products. Right, so you can see this is looking at detail, that's looking at just summary, just collect everything. Okay, so for example, marketing department, IT department, sales department, and let's say legal department. Okay, 4 different departments. Are all 4 departments going to be spending money? Yes, there's going to be a budget. Are all 4 departments going to have expenses? Yes. So financial accountants are going to do what? Collect the transactions from 1, 2, 3, and 4 and just put them all together. Management accountants are going to do what? Analyze the detail. Okay, so someone will be sitting here in this department and they'll see, okay, we spend money on this, we spend money on that, we spend money on that. Why? Because they need to know that. Okay, financial accountants don't really need to know that. They just need to know how much did you spend.
Yeah.
The total, okay, the aggregate, okay, to use that word. Makes sense. Okay, so that's enough that we need to write there, but I am going to say refer to that page. Just see page 444, brackets, table for, I'm just going to say comparison table. It's just something extra, it's just additional. A lot of it we've discussed, but we've summarized it. Here they've looked at more specific things. Like here they said, accounts usually prepared once or twice a year. Okay, here they specifically said, reports and data prepared as and when required by managers and owners. Right, so a lot of this you've got, but it's always nice to see what they've given you in terms of detail. Okay. Next bit, foundations of accounting. Key heading. Okay, so if I'm looking at accounting, what is accounting based off? Well, different principles. So the key underneath this, asterisk, basic principles must be applied. And the most basic principle is which one? Every debit has a credit, right?
Yeah.
Double entry. So number 1, double entry rule. That's the first basic principle. There's quite a few here. 1, 2, 3, 4, 5. 5. Okay, so double entry rule just in brackets here, DR equals CR. Every debit must have a credit. That's one of the principles. Okay, so number one is that. Number two, accrual versus cash. Still remember what that is?
No.
Okay, so accruals are when transactions arise and they don't necessarily have to be paid or received. Okay, so for example, let's talk about the business that you're starting in terms of the nail and beauty. So if you give a customer a service in terms of doing their nails and they don't pay you, are you going to still record a sale?
No.
Yes, you would. But what type of sale is that? It's a credit sale. Okay, a credit sale means you've sold something today, but you're only going to collect it in the future, right?
Okay.
What do we call those people that we sell to on credit?
Creditors.
No, that we sell to debtors. That's the one. Good. Okay, so debtors are people we sell to on credit. Creditors are who?
The us clients.
Correct, the suppliers. The people that we buy goods from.
Yeah.
So that's what they're discussing here. The textbook says, accruals arise when services have been supplied and the business has not yet paid. Does that make sense? Yes, it does. Why? Has there been a flow of cash? No. They said accruals arise when services have been supplied but the business has not been paid.
Yeah.
Right, so if the business hasn't been paid, what type of accrual is this?
The written off. I don't know.
Okay. An accrued expense. Okay, we need to revise a bit of this. Okay, stuff that we've covered long ago. Right, so an accrued expense is what? Something that I've incurred that I haven't paid for. Right, so if we've used the water and electricity, when do we get the bill? At the end of the month, because they need to measure how much water and electricity you've used. But now I'm still using the water and electricity, so do I owe the government? Do I owe Eskom? Do I owe Rand Water? Yes, I do. So if I owe them, an accrued expense is what type of account? An asset, a liability, an income, an expense, or capital joint?
An asset.
An asset. How is it an asset?
I don't know. I'm not able to them.
Okay, we need to revise those terms. So let's rather put this first. Assets, liabilities, income, expense, capital, joins. Right, these are the 6. Do they look familiar?
Yeah.
Okay. Can you give me an example of an asset and can you explain what an asset is?
Land, buildings, liabilities, a loan.
Okay, so land and buildings, just give me the definition.
Land and buildings.
That's an example.
Oh, asset is a resource.
Good.
Future benefit.
There you go. Okay, you've got that. So resource that gives future benefit. The ones that you've said are examples. Same thing for liability. What is it?
An obligation.
Good. Obligation to pay, future outflow. Example?
Loan.
Nice. Income.
I don't know how to explain it, but I know what it is.
Increase in benefits.
Yeah.
Right. So if you sell something, have you got something? Yes. Income is, well, example, we said sales. What other forms of income do you get?
Rent income.
Rent income,
Those kind of stuff.
interest income, services rendered. Okay. Expenses.
Decrease income.
Decrease in benefit. Good. Some examples.
There's lots of things.
So-
I know them. I
Just
don't
some.
need to tell you. Telephones,
Good.
electricity,
Good.
all that stuff.
Okay. Capital and drawings are special. Why?
Because they're their own.
It relates to the owner.
Yeah.
Right, so those are 6. So now let's go back to this. Accruals versus cash. If you sell something on credit, what type of account are you going to create? You're going to create a debtor because there's an asset that someone owes you and there's a income because of the sale. Right, but here they talk about debtors, they talked about people that haven't paid you. People that haven't paid you are called creditors. Expenses that you haven't paid are outstanding expenses called accrued expenses. Okay, so that's what they're looking at here. So in the textbook, in this textbook, the business one, they talk about accruals as amounts that are outstanding. That's what they're talking about here. They said accruals arise when services have been supplied but the business has not paid. So if we haven't paid, has that created an asset or liability? A liability, good. Okay, so it's just revision. We just need to jog the memory, just recap and revise those key concepts and then just apply them again. Okay. Right, the next bits. 3, the money measurement principle. Quite self-explanatory because you've got the word money measurement there. They said accountants need a common form of measuring the wealth and performance of the business. So when looking at business, this would be using a specific currency. So we can't use rands and dollars and euros and pounds. From a business point of view, you need to choose how you're going to measure your transactions. Right, so we're going to choose to either use rands or we're going to choose to use dollars. But whatever we choose, that's the principle we're going to follow. Okay, so you can't mix the currencies, you need to keep it as one. So how am I going to measure my money? Am I going to use rands, dollars, euros, pounds, whatever? Number 4. Prudence. That word you could probably remember, right? What does it mean?
I don't know what it means.
Okay, prudence, to be prudent. So let me ask you this. Do you think it's going to rain today?
No.
Probably not. Okay, we've got nice blue sky, the sun shining. It's not going to rain. If it was overcast and dark, what are the chances of it raining? Quite high. So if I'm prudent, would I carry around an umbrella?
Yeah.
I would if it was overcast. I wouldn't if it was sunny and blue sky. Okay, so prudence means to provide for something ahead of time, or just to be, the right word would be almost like forward-looking in a way, or like preparation, or I don't want to use an example here for accounting because it's not accounting, it's business. So maybe providing for the unknown. That's probably the best way of describing it. Providing for the unknown. Okay, so if I'm prudent, I'm going to carry around an umbrella if I think it's going to rain. It will be prudent to create an account for a provision or an allowance or whatever it is. Okay, that's more detailed accounting. I'm not going to get into that. Things you've looked at before. Okay, the next bit in your business textbook is realization. Okay, let's relate this to an example. Asset realization means, what have we done?
I don't know.
We've sold. Okay, so realization refers to the selling or disposing of assets to realize cash. Do businesses fail because they don't make a profit?
Yeah.
No, businesses fail because they don't manage their cash. Right, you can be unprofitable and you can continue to operate. That's possible. Businesses that start out aren't going to be profitable. Why? Lots of expenses starting out. Okay, but in the future, later on, it should become more profitable. Right, so the textbook here in terms of business talks about that. They talk about revenue and profit should be recorded in the account of the entity. They also say that goods that are bought and sold, payment needs to be made. If payment isn't made, will the business survive? No. That's why businesses go bankrupt. Okay, so now imagine this. Let's say you're going to keep selling and selling and selling, but you're going to sell on credit. Have you received any cash? Not a cent. But do you have lots of income? Yes, you do. And see, that's the big topic here, is profit actually means nothing. Because you can sell everything in your business on credit, and then you'll show a very big profit. But if you collect absolutely nothing, your business goes bankrupt.
Yeah, makes sense.
Okay. Next heading, business accounts. Okay, they said main business accounts, introduction, and then they're obviously going to split it into a few. Let's see how many they've given you. Okay, trading account is one there, appropriation account is another, profit and loss is another. So that's 3. Here they spoke about the sections, which is fine, we can mention that as well. 1, 2, 3, yeah, there's 3 business accounts, and then there's some other information. Okay, so 3 accounts. I'm going to put a heading here, 3 main business accounts. Number 1, trading accounts. We know that a business is going to trade, i.e. buy and sell. So a trading account shows the buying and the selling. That's what it shows. Right, from an accounting point of view, sales and cost of sales. That's what we're looking at. Just to read what the textbook has given you here. Where's it? Here's it. The trading accounts. This shows how profit or loss has been made from the trading activities of the business. It is very important to understand that not all sales are for cash. Some businesses sell goods on credit. The point of this is covered in more detail later. Okay, so that obviously comes up later on. Then they give you an example. They show you revenue, and they show you some income, and they show you some expenses. They talk about different types of profit, gross profit versus net profit. They talk about sales here and cost of sales. All right, so do you have the work program nearby? I just want to see how much of the accounting will they test in business. Like, do we need to go through the sales and cost of sales calculations again? We might, or we might not. It depends. Let's see. Okay, here in the work program, they said accounting fundamentals. They've even given an asterisk here. In the work program, they say this chapter could turn out to be a nightmare if you've never done accounting before. Not your situation. Okay, you've done accounting before. So I think they put that in there because some students are probably going to be like, oh my gosh.
Yeah, what's going on?
Like, what's going on here? Especially if they've never seen the stuff before.
Yeah.
Okay, I mean, like, you've seen a trading account, you know what sales are, you know what cost of sales are, so it's not a nightmare for you, but for some other students it can be. The textbook or the work program goes on and they say, however, the examiner will not ask you to prepare these accounting records, but you could be given an income statement or a balance sheet and be asked to amend it with new data. Therefore, you need to understand the structure and relevance of these statements. Okay, so that helps a lot. Right, so they're not going to ask you detailed accounting, but they can ask you to interpret and recreate those statements. Right, that's what they've given you in the actual work program. They say, please reference and read through pages 443 to 463. And there's another note here, monitor the business performance and taxes that are paid, and look at the cash flow statement, income statement, balance sheet. Fine. Then they've given you income statement, sample income statement, trading account, profit and loss. They talk about the different types of assets and liabilities, working capital, and that's it. Okay, so that helps quite a bit. Alright, so don't worry about sales and cost of sales in terms of the calculation. That we can do again in accounting. What you do need here though is the format for the different statements. Okay, so we've covered trading account. This is more than enough. What does a trading account show? Buying and selling, sales and cost of sales. That's it. Where's the other one? Here's the profit and loss. Profit and loss account. What does that show? Shows all the income minus or less all the expenses. And that's self-explanatory. Profit and loss means how much profit or loss do we make. How do we calculate the profit or loss? I'm going to have to take all my income and I'm going to have to subtract all my expenses and I'm going to get something. Again, don't worry about the detail. We'll focus that on accounting or in accounting. We just need to look at the key stuff here. Okay, the textbook in business talks about two types of profit. So just underneath this, just write down the two types. They talk about operating profits and they talk about profit for the year. Okay, the difference between the two is the one is before tax, the one is after tax. Okay, so they've even given you a bit of a formula here, gross profit minus overheads. Right, that's a little bit more technical, a little bit more detailed. I would maybe just say after tax or before tax. So just to put another note here, before or after tax profits. Okay, because the business will operate and they're going to generate income. SARS is going to want a share of your profits. And that's why you have before tax and you have after tax. Because you make profit as a business and then you need to pay SARS a certain amount. Whatever's left over, you keep. That's how it works. Does that make sense? Perfect. Number 3, appropriation. What form of business would use appropriation? Do you remember?
No.
A partnership. Why would they use appropriation? Well, how many partners do you have?
Yeah, split up profits.
There's the answer. Splitting up the profits requires an appropriation account. So from a business point of view, how do we share profit amongst our shareholders or owners of the business? There's dividends. That's what they've mentioned here. It's even in bold. So we need to define that. In this textbook, they're looking at the dividends. Dividends. In brackets, what is a dividend? It's a payout of profits to shareholders. That's what you've got there. Does a company always have to pay out its profits? No. Right, so when businesses don't pay out, there's the keyword here, retained earnings. Right, so when businesses keep profit, this is recorded as retained earnings. Right, very important from a finance point of view. Because finance is going to be looking at getting capital. So now if we've made a profit, do we need to go apply for a loan? No, we don't. If we've made a profit, do we have to go ask for shareholders to give us capital? No, we don't. Right, so that's why we need to look at this. Retained earnings. Two things. We can keep profit or pay it out.
Yeah.
You can decide. Okay, it's your business. Right, so those are the 3. Now we need to come back and we need to look at these statements. So the first statement is income statements. Right, so these are the 3 business accounts. Let's label that. Okay, and now we need to look at the statements. So statement number 1. How many statements do they cover here? Let's just double check. 1, 2, 3. Okay, looks like they only give you 3 here. Okay. They don't talk about the statement of changes in equity. Alright, we know more of them from the previous module. Okay, but in your textbook they only give you 3. So let's just write them down. I'm going to write down 3 of the 4 financial statements. Okay, so the ones in your business studies textbook are 1. Income statement. The more modern name for it is the statement of comprehensive, statement of profit and loss, and other comprehensive income. Okay, you don't have to write that down, but that's just general knowledge. Okay, so in today's world, they refer to it as a statement of profit and loss and other comprehensive income. In this particular textbook, they still talk about an income statement.
Okay.
That's the first one. So let me ask you, what do you think is going to go in an income statement? Yeah, 3 of the 4. I'm going to put the 4th in as well, but just as additional, because you are covering accounting as well. So it is worthwhile just to maybe revise that. But if it was just business, then I would just give you the 3 and just stick to the 3. Okay, but you do need it for the other subject you're doing. Okay, but we won't write anything on it. We'll just write it down. Okay, so for business, you need 3 of the 4. The 3 that you need to know that's in the textbook, number 1 is income statement. So the question is, what do you think is going to go in the income statement? 100%. Simple. Income and expenses. What do they give us? Gross profits, net profit, etc. Okay, why is that important? It's because we're looking at decision making. So from a financial manager's point of view, from a business point of view, the income and expenses are important if we want to go deeper and actually see, well, where are we getting our income? Where are we spending our money? But ultimately, we just want to know, how is the business doing in terms of performance? So that's important. Financial performance is communicated. Okay, so that's the first one. Let's highlight that. Income statement tells you about the financial performance. How good or bad are we performing? So if we've sold a lot during the year, performance is good. If we didn't, performance is bad. That's the business side of things. Accountants will look at, how do I record all of it? 2, statement of financial position. That's on the next page. That's on page 448. The statement of financial position, what do you think is going to be in here? 100%. Nice. Well done. Okay, assets and liabilities and equity. Okay, the key here is the assets and liabilities, because that gives you the net worth. So financial position looks at the liquidity / solvency of the business. Okay, so how would you describe an insolvent business? A business that has too much liabilities and not enough assets. Okay, bankrupt, insolvent. Liquidity is looking at how much cash do I have, how much assets do I have compared to liabilities. Right, the textbook's actually quite good here, I must say. In business, they gave you quite a bit of accounting actually. They gave you all these accounting terms with definitions. Hey, have a look at how much green they've given you there. Green definitions, green definitions, green definitions. There's a lot. Okay, so they might actually examine you on some of these because it's just theory relating to business, because it's categories or accounts that tell you about the business. Okay, so I'm going to go down the list. Tell me if you know them or don't know them, and then let's recap and revise them over here. Okay, the ones that you can't remember we'll discuss. All right, so...
But what is this under?
Financial position. Okay, so maybe just if you want to put a heading to this, we can say components. Components of the statement of financial position. All right, so in other words, what can you see in this statement? The first thing that you will see in the statement is an asset. Do you know what an asset is?
Yeah.
Liability. Share capital.
No.
Okay, what is share capital? Capital is money that's given by the owner. So if it's share capital, it's the shares that have been sold in the market. Share capital represents the capital received from having sold shares in the business. Okay, that's the first one, share capital. Do you know what a non-current asset and liability is?
Yeah.
Okay, that's fine. Do you know what an intangible is?
Yeah.
Intangible, just give me one example. Can't touch it. So maybe that one's quite a nice one to add here. Intangible, brackets, trademark, logo, etc. Do you know what inventory is?
Yeah.
Items to sell, right?
Yeah.
Stock, exactly. Do you know what trade receivables is?
Yeah.
Debtors. Okay, so people we buy or sell. People who?
So.
Who we sell to, yes. Okay, so I just want to add these as we go, just so you've got a note for it. Debtors / trade receivables. Do you know what a current liability is?
Yeah.
Short term.
Yeah.
Current means short term, non-current means long term. Do you know what a creditor is?
Yeah.
Okay, so that's another important one. Let's put that one in. Creditors / trade payables. And then they end with non-current liabilities, obviously long-term loans. Right, so if you know this point, it's great. If you don't, just refer back to this page 448. But yeah, your accounting is quite good, so I'm not too worried about this chapter. I think a lot of it might be boring because you've covered it before, and it's purely revision.
Yeah.
Alright, let's just see if we've covered everything there. I just want to go back and check. Income statement, I wrote down that. Okay, the textbook spoke about it as recording revenue, cost, and profit for the business over a given period. They say financial performance is going to be shown. They talk about operating profit. That's all fine. Okay, financial position. Oh, they did use the word net worth though. That's worthwhile. In brackets, inverted commas, net worth / value. Okay, that's a nice word to put here to describe the financial position. Okay. Okay, there's one more statement here, which is cash flow. Let's put it in. Number 3, cash flow statements.
Is that the third one?
Yes. There is 4. The 4th one I'm going to put here, statement of changes in equity. Okay, that one you don't need to know for business. That one you'll need to know for accounting. But at least we've revised all 4. Okay, cash flow is really easy. Inflow versus outflow. How much money comes in, how much money goes out. Okay, so that we've covered. Sections of the income statement. We can show an example later on. Trading account we looked at, profit and loss we looked at, appropriation we looked at. Okay, uses we haven't looked at. Next bits. Okay, is that it right? Are you happy with those three?
Yeah.
Perfect. Okay, so there's a heading here, users of income statements. Users or uses? Uses of the income statements. Okay, from a business point of view, we need to know how to use the statements, right? Because of decision making. But the accountants will create it. We need to use it. So now, as a business owner, how are you going to use a statement, a income statement?
Can I just see how I'm going to focus here? So yeah, it's the uses of the income statement.
This we've looked at already.
Okay.
We'll just look at this we haven't, but we'll put a note, non-current to current. Non-current to current, that's all there again. Working capital is something we need to write down, definitely. And then you've got ratios.
Yeah.
Ratios you can do on a separate page.
Yeah, so I'll just put this uses here.
Yeah, just put the rest of the theory here. The calculations we can put later on.
Okay.
Okay. Alright, so theory-wise, let's go back, page 447. Heading, uses of income statements. Remember, we're not focusing on how do we create these statements because the accountants will do that. What we need to look at is, how do we use what they've given us? That's important. Why? It's business. Okay, as the owner, someone else will create the statements for you. You need to use it for your business.
Okay.
Right, so this is important because this they could probably test in business. So can you think of a way that we would use the statements?
Yeah. Sandwich profit making.
Why?
See what we survive or not making.
Okay, that's good. So let's talk about this. See, they said, can we measure and compare the performance of the business over time? Is the actual profit different to the expected levels? Right, so for example, if you're running a business, will you have a goal or a target? You should. Okay, you might say, well, we're going to sell R1 million worth of items.
Yeah.
Okay, if I'm going to be selling R1 million worth of items, how are we going to do? And how have we done? Right, so have we sold or haven't we?
Yeah.
Okay, have we met the target or haven't we? If we haven't, then we need to call the sales staff in and we say, well, oh, okay, salesperson A, B, and C, you did well, you met your target, tick. Person C, D, and E, you're not meeting your target.
Okay.
Not good. Okay, let's see what we can do to help you. Okay. Alright, so number one, measuring. The cat's flying everywhere today. Okay, so measuring the income and expenses to get the detail, brackets, sales, goals, / targets. See, that's using the statements. Number two is summarizing the performance. So in other words, did we do good or bad? Okay. Let's summarize what they're doing in the textbook. They also said bankers and creditors will need the information to help decide on whether to lend to the business or not. That's a good one. So why would we ever want to get a set of financial statements? Is to get more money from banks, because banks aren't going to give you money if you don't have an income statement. Okay, banks are going to want to see, how is your business doing? Right, if they see, ooh, the business is doing well, then they're going to give you a loan. If they say the business is not doing well, they're going to say, no, go find the loan somewhere else. Okay. So number three, accessing or applying for more finance. E.g., a bank would want to see the income statement. Can I abbreviate IS? Okay, I can't fit in the whole word there. I'm just abbreviate IS, income statements. Or actually, let's use the one that you're more familiar with. Statement of comprehensive income, COCI. That one you know. Okay. Another thing is prospective investors want to assess the value of putting money into the business in order to receive a return on investment. There's another reason why we want the statement. Okay, so it's not only to get a loan from the bank, but it's also to attract new investors. Number 4, attracting new investors. Brackets, shareholders want a return on investment, ROI. That's what they want. Another use of the statements. Do you think STARS is going to want to see this?
Yeah.
Why? Why would STARS want to see it? Exactly. There's the next point. Governments, e.g. SARS, will have to tax businesses. Something else to consider. Another use of the statements. One more. Managers may award bonuses based on performance. Right, so how has the company done? If the company does very well, let's give everybody a bonus. If the company doesn't do well, no one gets a bonus. Another reason. Okay, so that completes that bit. They've looked at profit here, low quality profit, high quality profit. That's an interesting concept. It's just a definition here in terms of the green definitions. They talk about low quality profit and high quality profit. So let me use an example. Do you think it's good or bad to sell inelastic goods?
Bad.
Inelastic means goods that won't change in terms of quantity if the price changes a lot.
Yeah.
So if I change the price of bread, people are still going to buy it.
Yeah. So that means it's elastic.
It's inelastic. Yeah.
Okay.
Elastic means I can stretch it a lot.
Yeah.
Okay. Elastic is I can't. So people buy bread irrespective of the price. It's inelastic. Yeah, I'm just bringing you some economics. That's what they're kind of expressing here in terms of high quality profit and low quality profit. So do you agree some things you can sell very easily and some things you can't?
Yeah.
Okay. So if we're looking at, let's say, the beauty business, it's probably easy to sell the service because people are lazy, they can't do their own nails.
Yeah.
But not everybody would want to buy the products.
Yeah.
Because why would they buy products if they don't do their own nails? Does that make sense? Okay, so high quality profit would be from the service that you give, and the low quality profit would be the sale of the paint, or the, what do they call it? What do they call it? It's not called paint. Nail polish. That's right. That's the word I'm looking for. Okay. Alright, financial position we looked at just to see if we need to add anything to our notes. Let's just go back. Okay, we wrote a lot there. They spoke about equity. I didn't mention that, yeah. Okay, share capital, you know, we spoke about that earlier. That's fine. Okay, then non-current and fixed. And I think they contrast it with current. Yes, they do. Right, so new page. We can actually fit it here at the bottom. Timing. Non-current. And current. Non-current, you should know from previously, means long-term. Current means short-term. And that's it. Okay, you know that you get non-current assets and you get non-current liabilities.
Yeah.
You also get current assets and current liabilities. So they've given some examples here for the non-current assets. So I'm just going to add some examples next to this in terms of timing. So non-current assets e.g. patents, trademarks, etc. Copyrights. Intellectual capital. Maybe that's quite a good word to use. They've mentioned that in bold. Intellectual capital. Okay, intellectual capital is where you're using your mind to create something of value.
Yeah.
Right, so a patent is somebody's like design, that's their idea. A trademark is somebody's like
logo.
yeah, kind of like a logo, exactly, good. Copyright would be writing a script, writing a play, writing a performance. Okay, so if we had to write a play and put it on stage, or even like create a film, that would have copyright. Okay, or like a video, or like a music, or like anything that you watch on YouTube or whatever the thing is. So if you create it, there's a certain level of copyright. Okay. That's fine. This is very important because I saw this in here. Remember they said some students are going to think that this is a nightmare, okay? But they don't want you to think, wow, this is crazy. They want you to only look at this. They said just look at the income statement and balance sheet, asked to amend the statements. So please look at the format that they've given you here. NB format for the statements. Brackets. See page 449. Okay, remember this might look a little bit different from your accounting. Just bear that in mind, because in business they're going to test business, and then they're going to use the information from the business textbook. So just when you do go into the exam, maybe just look at this just to get a feel for the templates, just in case you have to, as they said here, fill in different amounts. Okay, fill in amounts that are missing perhaps. Okay, we'll do calculations. Right, so let's just discuss this. Non-current fixed assets, how many do you see here?
3, 4.
4. Okay, if I add up all 4, I get the total.
Yeah.
So 442 is the total for the non-current assets. Okay, how many current assets do you see here?
3.
3, good. If I add up that, I get 66. Do you agree total assets will be the non-current, which is the 442, plus the 66 gives me that. Okay, that's how they've done it. Right, this looks the same as the accounting. That's not too bad. This side looks similar, a little bit differently at the bottom. Okay, equity and liabilities, current liabilities, how many do I have? 2. 1, 2, and a total.
Yeah.
Non-current, how many do I have? 1. So the amount is the same as the total. Got that. Okay, and then total liabilities would be your non-current, which was the 73 plus the 125. Okay, give you the total liabilities. And then at the bottom, normally when we looked at the accounting, normally they put the equity at the top and the liabilities at the bottom.
Yeah.
Here they've done it the other way around, but it's still the same. Doesn't matter, as long as you've got all of it. Shareholders' equity, 2 different types, the capital and the retained earnings. Okay, remember retained earnings is profit that I don't pay out. If I don't pay out the profit, who's entitled to the profit? The owners.
Yeah.
Okay, so even though the profit is sitting in the business, it still belongs to the owner. That's why you put it as part of owner's equity. Okay, that's all. Just familiarize yourself with the format. There should be an income statement here as well, unless I skipped it here. Oh, okay, but that's not a very good. Look how bad that looks. Okay, that's not a very nice statement. This one looks better though. Yeah, because they don't have all the pluses and minuses. All they kind of use the same thing. Okay, I really don't like this format, but it looks like that's all they've given you. Okay, so we're going to have to reference it. And page 446. Right, so 446 gives you the income statement. There's it there. 449 gave you the financial position. Right. We'll look at these things when we look at examples in the past papers. Okay.
So I start working page.
So that's done. We spoke about non-current and current. Working capital, just want to put a note here for that as well. working capital equals current assets minus current liabilities. I even remember that from your previous chapter. Remember one of the chapters we had working capital, or we had working capital management. I think that was the heading. So it's actually repeat. Working capital is assets minus liabilities. Current assets minus current liabilities. Okay, shareholders' equity we spoke about, non-current liabilities we spoke about, other information, cash flow we spoke about. Okay, now we need to look at the ratios.
Can I run to the bottom of your first?
Sure. Okay, so the last bit in this chapter, 6 pages looking at ratios. Separate heading. Still accounting though, still chapter 30. Okay, I just want to add just one extra note here in terms of the financial statements. Financial statements don't have ratios. Okay, why don't financial statements have ratios? Because the accountants create them, and those statements need to look in a very specific format. Okay, so I can't change the way something looks, but I can analyze how it looks. Does that make sense? Okay, for example, a person will either be tall or short. Okay, that's what the individual looks like. They're either very fat or very thin. Okay, so if I'm looking at the financial statement, the exact same thing applies. An income statement is going to tell me how much income I make and how much expenses I pay. But the ratio is going to tell me more in terms of the analysis. Okay, so if I talk about height and weight, from height and weight, I can measure the body mass index, the BMI. Okay, and that's going to tell me how healthy or how unhealthy the person is. Does that make sense?
Yeah.
Okay, same thing here. So in the statement for income and expenses, I'm going to see income and expenses. That's not going to tell me how, inverted commas, healthy the business is. The business will either be operating well or not based on this. Okay, that's what we need to look at. So ratio analysis uncovers more details relating to the business. Okay, what do I mean by that? Specific measures for specific sections or areas. Specific areas of the business. Let's use that. Areas of the business. And that's what we're going to be looking at. The textbook did mention just other parts of the report. Okay, so when we do look at a set of financial statements, you don't only have lots and lots of numbers and things like that. You also have people's view. So do you think the chief executive officer is going to write a little message about the business?
Yeah.
They would. Okay, so the person in the biggest or highest position, CEO, is going to write down a report. They're going to give the shareholders their view. Do the auditors audit the reports? Yes, they do. Are the auditors going to give their view?
Yeah.
Yes, they are. Okay, so everybody that's very, very, very influential is going to give a view on the business. The chief executive, the auditor, there could be others as well, and that's part of the report. They literally just give you like 2-3 sentences here about that. Then they talk about the ratios, so let's label them. Number 1. First ratio that's in your textbook, gross profit margin. And this might even be revision from accounting as well, because we also looked at ratios previously. Gross profit margin. The formula for it is gross profit over revenue. GP over REV times 100. So if I take my gross profit and I divide it by the revenue, I'm going to get the gross profit percentage. Just to revise though, how do I calculate gross profits? Sales minus cost of sales. Okay, that you're also going to have to revise. Okay, that's ratio number 1 in the textbook. Ratio number 2 is operating profit margin. That's number 2. How do we work this out? Same thing as before, except I changed the numerator. It's OP, operating profit. What I'm going to do is here, just use some color, so that makes sense. So GP is that, and OP is this. Just so you know what I'm referring to, divided by revenue. Now on your notes, maybe write up the whole word, okay, like you did, they're perfect. I'm just trying to abbreviate here so I can fit it nicely. OP, operating profit margin. Okay. Right, so operating profit is looking at how much I actually make after taking other expenses into consideration. Next ratio, current ratio. That one you probably remember from accounting. Current means current assets and current liabilities. So the current ratio equals current assets divided by current liabilities. Straightforward. Remember, some are easy to remember. The word current means short term, so just take your assets divided by your liabilities. Let's see, what else do we have there? Increased profit margins. Okay, there is some theory here relating to the ratios. So after they've given you that, they've given a bit of an explanation about it. So these profit margins, do I want these margins to be higher or lower?
Higher.
Good. Higher margins are better. Okay, for both. Right, so for gross profit and for operating profit, you would want a higher measure. Right, so if the answer is 50% compared to 20%, 50% obviously means that the business is doing a lot better than the 20% business. Okay, that's just common sense. The higher the percentage, the better. Same thing with the current ratio though, except the current ratio is looking at an answer or a measure greater than 1 is good. So if I've got a fraction, numerator and denominator, if my current assets are bigger than my current liabilities, will the answer be bigger or smaller than 1? If your current assets are bigger than your liabilities, let's say this is a 2. 2 divided by 1, is that bigger or less than 1?
Less than. No, not bigger.
Yes, okay, because 2 divided by 1 would be 2. So any number that's bigger than 1 is good. 1.1, 1.2, 1.3, 1.5, 1 point anything. It could even be bigger numbers. 2, 3, 4, 5. Any number bigger than 1 is good. Why is it good? Because, let me put a note here. Good because CA greater than CL. Current assets greater than current liabilities. And that's why we want it bigger than 1. Next ratio, asset test. Number 4. Asset test / quick ratio. Remember there were 2 different names for it, quick ratio. Okay, this one I need to show a numerator and denominator. So in the numerator, it's current assets minus inventory divided by current liabilities. Okay, this one I'm going to show as a big fraction, like this. Okay, that's asset test. What else did they give you here? Oh, okay, that's it. Nice, only 4. Not so much to study. That helps a lot. Okay, perfect. Last bit is just some theory here. Actually, maybe, can we finish the other 8 pages here? What is the time? Yeah, we might even be able to do it today. Unless you're tired.
No, I'm okay.
You're fine. Yeah. Alright, so.
Lately I'm a bit stressed out about everything.
Yeah, I get it, I understand. I mean, you're busy with so many other things as well. It's hectic. Okay, so the last bit here that we need to write down is just the decision making. Okay, so one more page for ratios, and then we're good with this section.
Can I just get the asset ratio?
Yeah, sorry. Yeah, so current ratio is quite a simple one. Asset test is also quite simple. Maybe just gross profit and operating profit you might have to study, but they're also straightforward. Both of them are divided by revenue. Okay. Alright, so then, as I said, there's just one other note to write down here regarding the ratios. Okay, so same heading here, but just some theory points. Okay, so remember, this is business, not accounting. Okay, so we're not going to be looking at like all the detail around these ratios. We're going to look at how do we use the ratios to make a decision. That's important. Okay, because accountants will deal with that. Financial managers and business owners would use the information. So again, how do we use the ratios? Okay, the textbook actually talks about this as evaluation. Ratio evaluation. Ratio evaluation. Right, so if I'm dealing with a ratio, I need to evaluate how well this is in terms of making a decision. Right, so they've given you a few notes here. Can you just see how best can we summarize this? Okay, because there's points here and then there's points there, but let's look at the evaluation. Okay, let's do this. Let's put a note here. A. Okay. Ratios provide info on the current scenario. That's the current situation. What's happening today in terms of the numbers. Right, so looking at my statements, I'm going to take that information and I'm going to use it to create a ratio. That ratio is going to give me information on the current scenario. Right, the textbook gives you some tables here that talk about the evaluation. So that's what I'm trying to summarize here. When you've got the current ratio, then what do I need to do? So point number one, is we need to look at increase or decrease from last year. That's the first that we need to do because it's the current scenario. So did we improve on last year or didn't we? See, that's part of the evaluation. Okay, it's like marks. Last year compared to this year. Or okay, well that's not really a good example because obviously the next year will be more difficult than the previous year, but maybe terms is better or assignments is better. So one assignment versus another assignment. Okay, evaluation. You always have to compare it to the previous one. Okay, and that's what we're looking at here in terms of the ratios. That's what the textbook's describing. But how do we actually evaluate the ratios? We need to look at year on year. Has it increased or hasn't it? Next bit. Okay, when we look at increase or decrease, maybe just to put a note here, it can be in rands, so in monetary amounts, in monetary or percentage terms. Because you can look at, well, last year I sold 1 million, this year I sold 2 million. Okay, or you can say, well, last year it was this, and this year it was 10% or 20% more. Does that make sense? Okay, so it's either in rands or in percentages. Okay, then they talk about factors. So what factors affected the ratio? E.g., was there inflation, comma, was there theft, comma, was there a natural disaster, was there a recession? We need to look at that. Okay. And that's it. I do want to look at some of these examples, just one or two of them, but I'm going to put a note here. See examples in the table on page 455. Okay, I like the way they've written it out because they've shown you this. They've given you the method to increase something, okay, one of the ratios. So if I want to increase my sales, what am I going to do to increase my sales? There are different examples, and then we need to look at the evaluation. Did it work or didn't it work? Right, so I'm going to use my own example here, not the ones in the textbook, just to describe it. Okay, I want to keep it simple. These are quite long. Okay, so step number one. Step one, let's talk about an objective. Our objective is going to be to increase the gross profit percentage. Okay, so step one, we want to increase the GP percentage, gross profit percentage, or let's use the gross profit margin. Okay, step number two. Step two is give examples of how we could do that. So how would we be able to increase this?
Increase sales.
Perfect. How can you increase sales? By marketing the products. That's all.
Extend your product range.
Perfect. There you go. So now we can look at that. So step number two is we could increase the selling price, or we can do marketing to increase sales volume. Right. Step number three would be to evaluate how much impact that had on the ratio. Okay, so then you look at the ratio now, you do the marketing, you do the advertising, you increase the price. Next month, you measure it again, and then you compare. Did it actually make a difference? Okay, that's what they're trying to say here.
Okay, cool.
Makes sense? Perfect. So that completes this chapter. We spoke about this, maybe limitations. We can maybe say one thing about that, but let's squeeze it in here then. Ooh, running out of space. Okay, let me make one more slide just to put this here. Limitations. Okay, the most obvious one is based on past information. It's summarized, not detailed. Here they said info could be incomplete. Incomplete information. They said poor results. Done with caution. So with ratios, it's always, because remember, ratios look at the summarized information. It's never detailed. So it could be inaccurate. Maybe that's another thing. Possible inaccuracies. Okay. And then just to put a note here, users of accounting, internal and external. Example, investors, SARS, government, suppliers, customers, etc. Okay, lots and lots and lots and lots of people use the ratios for different reasons. Okay. Some examples here: banks, creditors, customers, government, investors, workforce, all the ones we've covered in accounting. Okay, and then this is the limitations again, because things aren't accurate, things aren't detailed, performance could differ, the budgets are possibly based on inaccurate estimations. So there's a lot of factors there for risk when things aren't completely accurate. Okay, remember, it's difficult to forecast, it's easy to cover what has been or what has happened. Okay.